ETF due diligence. So ETF due diligence is something that every investor must perform on their own instead of listening to hearsay and kind of looking at the names of ETF and deciding to just jump in an ETF without doing your own research. And then this is very dangerous because if you come with the mindset that, ETF is very simple. If it's a passive investment option, it is all plain vanilla, and nothing can be more untrue about what to that extent. So you can see that one of the first thing that you must put into your mind is this first commandment: thou shalt not pick an ETF based solely on the name. Now, why is this the case? The best example, April 2020. Now, this will be a period where, today everybody that drives car will complain that it's very expensive to pay for petrol at the fuel pump. Right? Why? Because crude oil has been trading well above 100 due to the current geopolitical situation that is happening around the world right now. But guess what? In April of 2020, if some of you can remember, crude oil went the other direction. At first, it dipped below 40. And just for a very brief period, it went to minus territory. So what would most people want to do when they want to take advantage of a situation like this? Now, a lot of retail investors blindly buy into what is called a oil ETF, not realizing the exposure that they are getting themselves into. And in this case, a lot of investors got burned, thinking that they got direct exposure to crude oil, but in actual fact, they got into what is called a crude oil futures exposure, which lands them in a situation where there are very limited slots available for delivery, which means that they got to end up to do short covering and suffering a lot of losses. So this is where this lesson on selecting ETF is very important. Selecting ETF, I'm going to be touching on these 5 core components that you must pay attention to. Exposure, what does it hold? How does it hold it? How is the index constructed? Cost expense ratio, tracking error. Now, tracking error is a measurement of how an ETF lags or exceeds an index. And of course, you may be thinking, if an ETF exceeds the performance of the index, is good, right? Whereas if an ETF underperforms an index, it's bad, right? But in the context of a person who allocates money to ETF, both are just as bad, because this tracking error, whether is it positive or negative, just tells me that the ETF is not very reliable, because a reliable ETF is supposed to track its index very closely, which means that it has got low tracking error. Trading costs, we're going to be talking about looking at the whole thing in terms of the overall expense ratio concern. Of course, all things being equal, if you can reduce your costs, you get off to a very good start compared with your competitor. The bid offer spread, we'll also be talking about liquidity in terms of the traditional liquidity, but also the implied liquidity. Risk in terms of standard deviation, as well as closure risk. Now, standard deviation is easy to explain, but closure risk, what exactly is closure risk? Now, an ETF, there are certain ETF whereby after it is listed, it remains on very low volume for a very long time. And as a result of low volume, it will suffer what is termed as closure risk. There isn't enough of the AUM to support its existence, right? So be mindful that not all ETF are created equal. And that is why the last component comes in very important. The track record, the history, the AUM of the fund concerns, these are factors that we have to take into account. Exposure. Selecting ETF exposure. One of the very best place that you can look at is to go directly to the index creator's website and download the index fund fact sheet, right? The index fund fact sheet will give you a lot of details, right? So here, let me illustrate using the SGX website, where you can locate many of this useful data. So if you can see on my screen here, typically we make use of the security tab a lot. And this is one tab that not many people visit. And this is where you can see here, you have index category, whereby you have equity indices, derivative indices, fixed income indices. And then below here, some of these featured indices, including the STI indices. Let me just give you an example using the IH S-REITs index, right? So if you click into it, there are a lot of details that are provided, not just the pricing data, but also resources like fact sheet, which are available, and I highly encourage you to read through. All right, here it gives you an example of this is a question that I often encounter. What is the difference between the IH S-REIT index and the IH S-REIT leaders index? It all has got to boil down to what exposure you are getting. What exposure you're getting. Now, the IH S-REIT is a free float market cap weighted index, whereas the S-REIT leaders index is the most liquid representation of the S-REIT market in Singapore. So here's the key thing. It says it's an adjusted, the term here is adjusted free float market cap weighted index. Yeah, and then as you download this index, you got more questions. It's like, what do you mean by adjusted free float? Again, such information are available on the SGX website. Here you see the resources, the methodology here. If you download it, these are explained in very clear detail in this document. There are 15 pages that gives you what will be the universe, what will be the criteria. It gives you the formula, the the kind of criteria involved, the weightings and all that, how the constituent is adjusted for this leaders risk index. Okay, so this is an example of digging into the exposure. Okay, so beside exposure, you will want to know how does the ETF replicate the index concern. Okay, so in this case, after considering and reading about the index concern, after I have a great understanding of the index itself, after I know what I'm getting into, I want to know if, remember the 4 replication method that we talked about, full replication, sampling, optimization, or synthetic. I want to know which method is being used because that tells me a few things. If it's full replication, I know that there will be lower tracking error. And if it's synthetic, then I know that the tracking error could be more, which I need to really reconsider whether it will be a suitable investment option for me. All right, so in this case, I can tell here over at the index provider's website, it tells me the replication methods. It even gives me things like the trustee name, the distribution frequency, and this refers to the payout of dividend concern that I'm looking at. And it also tells me the next things that I want to talk about, which is cost. Now, total expense ratio. This is the first thing that I'll look at. And it all adds up. And of course, all things being equal, the lower the expense ratio, the better it is for the ETF. And you have to also consider other aspects such as tracking error, right? So this is again another example. And all this, where to find? Again, this all can be found in the index provider website. And of course, if you are referring to the whole series of index that are provided by SGX, it is at the location that I just shown you earlier on. Another core aspect is this thing called the bid and offer spread. An ETF with a smaller bid to offer spread is always better than one with a bigger bid to offer spread, right? So all other things being equal, because you are able to execute your market order at the level that is closer, and that reduces your cost quite a bit. Now, when I show these slides to most viewer, they will tell me first thing top of their mind, this looks like an onion, right? Yes, it does look like an onion, but what I want to show you is that the ETF liquidity is very complex, and the most complex of which lies at the core, and that is correlated trading vehicle. ETFs volume are not reliant simply on the underlying basket of security, but also on many other things. The related derivatives that we're talking about, the correlated trading vehicle, such as options, futures, the underlying basket, of course, that is very important, but that is just one aspect of the entire available liquidity. Now, to give you an example, let me just illustrate this using two well-known example that you can look at here. Now over here, if you follow my highlighter here, this bid offer spread. Now below the bid offer spread, you can see this line called the 90-day average aggregate volume. Now this average aggregate volume is 101.8 million. And below that, there's an implied liquidity. The implied liquidity of this contract, which is the S&P 500 ETF, arguably the most actively traded security in the world today. The implied liquidity is 53.3 million versus the average aggregate volume, which is 100 over million. Now, what that tells you is that the implied liquidity, the underlying basket itself, only explains about 50% of the actual liquidity of this ETF itself. Why? Because there are many other instruments available to gain exposure to the S&P 500 index. For example, S&P 500 futures, options, various other off-the-market contract that are written based on this index itself. Next is an example here on the STI. The 90-day average aggregate volume is 592.1K. Okay, so it's pretty substantial, very good volume, but then again, the implied liquidity here is 27.9 million. Here, the underlying security itself explains quite a bit of its security. And the underlying security itself is also, you could gain other exposure as well in terms of options, derivatives, contracts for difference, and various other futures and derivatives that are underwritten by investment banks. All right, so the implied liquidity itself is 27.9 million. So what I'm trying to put across is this. An ETF is as liquid as its underlying, which might not be reflected on just the on-screen itself, right? Because on its underlying, there are many other things that are attached to it, right? So there are many factors which affects an ETF's liquidity, as illustrated by this onion that you see on the chart here. So an ETF is as liquid as its underlying, which is not reflected. So how does an ETF liquidity differ from other investment? Well, the liquidity sits with the market makers in the primary market that forms the core, and of course in the market makers inventory, and that is where the borrowing market is. And finally, at the tip of the iceberg, what you see, the secondary market is simply a tiny portion that doesn't really kind of reflect the underlying itself, right? So I just want to show you this chart to kind of give you a very good example. In terms of mutual fund, you can see, of course, it all lies with the market maker, all right? But for ETF, it's the entire field here, all right? The primary market, the market maker, as well as the secondary market. I want to next touch on this aspect entitled the risk of trading ETF. All right, the risk of trading ETF. So a few risks that we need to talk about. Firstly, market risk, tracking error risk, counterparty risk, liquidity risk, and foreign exchange risk. Now, market and credit risk. So this table that you see on the right are actually extracted from a document that I pull from the SGX website. All right, so this is called, let me just show you where you can locate this, especially for ETF that are located on the local exchange. So if you go to security and you tap on the ETF screener, you will come to this very handy ETF screener that will allow you to gain access to what you are looking for. Most of the time, I want to illustrate this first. There's this thing called EIP and SIP, which is very unique to our local regulatory environment. EIP stands for Excluded Investment Product. Okay, and SIP stands for Specified Investment Product. Specified investment products are products that you have to be qualified, pre-qualified. All right, so among the ETF here, you can see that some, after you click SIP and you click submit, there are 7 issues here that are SIP. You have got to be pre-qualified. In other words, your stockbroker would have to pre-qualify you, or you would have to go through a tutorial plus a test to prove that you pass the qualification in order to buy into any of these ETF. Right, so which means that for most investor, this 45 listing here that you see are the one that are most relevant. Right, so you can see here, if you want to download the documents that I'm talking about, prospectus, monthly reports, the product highlight sheets is what I just shown you earlier on. Okay, so while this is loading, let me just don't waste any more time and go back to the slide here. It will highlight to you what are the principal risks involved in that particular ETF. So make sure that you read into that, and the product specific risks, whether this fund is being you know, what sort of a product specific nature is related to the particular ETF concern, and then liquidity risk, what will affect liquidity risk in this particular extent. All the relevant issue will be highlighted in here. As I mentioned earlier on, ETFs screener is where you should begin this aspect of the research. All right, so finally, before I go into a snapshot of what is available on the ETF platform, I want to touch on how does an ETF fit into your portfolio, right? So most of you are already familiar with mutual fund and unit trust. So ETF can take the place of a unit trust or any mutual fund portfolio as long as the underlying exposure is similar. On top of that, it can directly track spot gold prices, where mutual fund only invest in company related to gold or gold mining. Also, you know, an ETF allows diversified exposure to broad market and generally carries lower risk compared to investing into individual stocks. Why? Because it's a portfolio holding. And now ETF allows you to take on a broad-based top-down approach and capitalize on broad themes. Now, for example, this example that I like to use is you know, a lot of people often use the term, whenever I have a chat with them, I have encountered people who tell me, if the stock market crash, I'm going to buy this stock, I'm going to buy that stocks. But eventually, they don't end up buying anything. Why? Because they don't really know what to buy. And they don't really know whether what they are getting into, is it at the bottom? Is it diversified? What if they do the security selection wrong? They might simply lose every single cent that they have. Now, for example, the global financial crisis, when the stock market crashed, everybody will say, I will buy bank stocks, right? I will buy bank stocks. Or you don't have to buy bank stocks. You can simply buy a bank ETF. Or you can buy a broad market index such as the STI index or the S&P 500 index, which both has got an ETF that are listed here at the SGX, right? So you can take a very broad-based approach without subjecting yourself to individual security risk. You can overweight certain country or sector very easily. For example, if you feel that the last few days technology sell-off is an opportunity that, for you to gain an entry point, you might decide to simply buy into a technology ETF, which we can discuss, all right, which are the one when we look at some of the portfolios that are available, some of the ETF that are available locally.